Welcome to The Heart of the Matter, a podcast that covers legal developments from around the world. I'm your host, Stephen Lai. This podcast is brought to you by Conventus Law. In this episode, we'll be discussing investing in ESG. Joining me in this discussion are lawyers from the Stevenson Harwood Hong Kong office, Penelope Shen and Tze-wei Ng. Before getting to the heart of the matter, a message from our sponsor, who generously supports this podcast.
Ashford Benjamin was founded with the belief that search firms should offer a better service to clients and candidates. This means taking the time to provide a genuine partnership, understanding our clients' and candidates' needs, and proactively advising on the best course of action, utilizing the decades of experience in our industry specialisms, including risk, compliance, business and legal recruitment consultancy, located in central Hong Kong, serving Asia Pacific.
Welcome back, Tze-wei. Welcome back, Penny.
Hello, Stephen.
Great to have you back on. We talked about laws and regulations. We talked about culture in our last two episodes. I guess this episode is all about how do we make money from ESG, investing in ESG. Now, in the short term, I'm struggling to see how you can make money, but maybe you could tell me a little bit more. Tze-wei, is it worthwhile for investors to consider ESG investing right now?
Well, we would say yes, for sure. And there are many reasons, money making just being one of them. So Penny has already spoken much about regulatory trends in our last episode. However, it is about money making, so we do want to think more about the opportunity side of things. If we look at figures alone, sustainable and responsible investments now stand at US $35.5 trillion, making up more than 1/3 of global assets, according to the Global Sustainable Investment Alliance data. The community of investors investing in this type of investment, according to UN Principles for Responsible Investment, UNPRI, they now have over 5,000 signatories, more than 2 times growth since 2017. So there are just more and more investors, more and more products. And if you can invest in companies or funds that are not only sustainable, but also benefiting communities they work in or contributing to climate solutions, why not? But I would also like to bring in other factors why it's worthwhile for investors to consider ESG. There is increasing talk about purpose of business, and there is also increasing talk about the need to move towards a stakeholder economy, questioning where has profit maximization taken us as a global community. And if these are too philosophical, another way to answer this question is urgency. So the challenges we face today collectively are immense, whether it is climate change or growing inequality. We simply need all hands on deck, whether it's government, philanthropy, businesses, investors, to address these challenges. The SDG financing gap for the UN Sustainable Development Goals figures is that it would increase 70% comparing before COVID and post-COVID. So the other answer to this is we simply just need more good finance than bad finance. And we just need more investors with that capital for our people and planet. Last point, case law is also showing a shifting understanding of fiduciary duty. A latest report by UNEPFI Environmental Program called Fiduciary Duty of the 21st Century, it concludes that the conceptual debate is basically over. Investors who fail to incorporate ESG issues are failing their fiduciary duties and are increasingly likely to be subject to legal challenge. And empirical and academic evidence have demonstrated that incorporating ESG issues is a source of investment value. ESG analysis assists investors to identify value-relevant issues, and neglecting ESG analysis may cause the mispricing of risk and poor asset allocation decisions, and therefore is a failure of fiduciary duty. So yes, the answer is worthwhile and is simply necessary.
It looks like, certainly in the business sector anyway, it's going to be on board with ESG whether they like it or not anyway. So would it be fair to say in the future, it won't be called ESG investment, it'll just be investing?
Yes, definitely. I think quite a lot of us who believe in sustainable finance would think that in the future, finance would just have to be sustainable finance.
I guess what the regulators are trying to do, like even what I'm seeing, the fund managers, I think the ultimate objective is just to make the fund managers consider ESG, climate risk, and just be just like considering political risk, market risk, other investing different products, just to make it as part of their consideration when they make the investments. I think that is what a lot of the regulators try to achieve.
Hmm, interesting. It certainly sounds very attractive, right? I mean, there's lots of ticks in the boxes. Sticking with you, Tze-wei, are there any factors that investors should consider before investing into ESG?
As lawyers, we are not investment experts, so perhaps we can only just say it from more our general observation and perhaps my experience working with private investors and family offices in my last role with Sustainable Finance Initiative. So I would say one way or one factor to consider when you start is to become familiar with the different types of different ways or strategies to engage in ESG investing. Penny mentioned earlier on in previous episodes that there's negative screening. You can adopt a negative screening approach to your investments, namely not investing in certain companies or industries such as oil and gas or arms or tobacco that is not aligned with your values. But you can also be engaging in deeper type of ESG investing like blended finance, like sustainability, themed investing, where you are deliberate about the positive impact that your investment can create. You can specifically invest with a gender lens or climate lens, specifically giving funds to companies with female entrepreneurs or contributing to climate solutions. Or you can even be more impact focused, finding impact funds or companies that are working on particularly challenging issues from social housing to education for girls. So as you can hear, each of these products may come with it a different, what we call risk, return, and impact makeup. And it really comes down to your appetite. And it may take time for you to test what will work for you, perhaps as a whole portfolio. So the family office I used to work for, as I mentioned, is a leader in impact investing and sustainable finance. And it took the team 8 years to transition their whole portfolio asset class by asset class into for impact, such that impact cuts across their whole portfolio from investment to philanthropy. And there is same value lens being applied. The question that triggered the journey for this wealth owner is the question, so what is the purpose of capital and the impact she wants to create with her investment and her wealth? So I guess this is another key factor I would say that would be relevant when investors started considering ESG investing.
This is an interesting question. Are companies with strong ESG credentials likely to perform well or better in the long run, as opposed to companies with not so strong ESG credentials?
If you read the news, you definitely read a lot of controversies around ESG ratings, right? How the same company may rank very differently on different ESG ratings, how these ratings have very little correlation. I would argue that if we go back to the purpose of ESG and what it means for a company to truly care about ESG and how the regulatory environment and consumer demands are changing, and also how increasingly externalities like pollution is being priced, then it seems only natural that companies with strong ESG credentials will perform well in the long run. What we as a market has to do, though, is really to be aware of ESG washing and to deepen our ESG practice. So whether as companies or investors, we need to continue to learn about ESG, not just the general concept, but also what does it mean for each particular company to be ESG integrated. The ESG factors that matter to a tech company, say, for example, would be rather different than ESG factors that matter to an agricultural company or shipping company. And for each company, the E or the S footprint may be vastly different. So the kind of ESG factors that are material to this company, the ESG risk, and the ESG impact that unique to this company will be very different. And as investors or as companies that really want to do well, we need to be aware of these nuances and not just following the general ESG boxes.
Oh, thank you for that. And that's really interesting. I remember last year I was actually at a dinner gathering, and it was hosted by a forensic accountants company, and they did this fun exercise actually on valuing companies with strong ESG credentials against companies with not so strong ESG credentials. And what I thought interesting was that they had these, like, it's all, they got their own formula of doing it, obviously, but they turned it into a little game, and they had these sort of hypothetical businesses, doing, one company was doing this and the other one was doing that, but they do the same, they're in the same industry, but their practice is a little bit different. And we all got shown this formula and how the each company would be valued. And it was really interesting because I think the company that had stronger ESG credentials definitely ticked all the boxes of the higher valuation, as opposed to the other alternative. So your answer was very interesting. I just remembered when as you were answering, I remembered that exercise we did last year.
Yeah, I think you actually point out one key thing here is the formula. So the different ratings, like what formula do each of them use? And this is where we are lacking consistency and comparability in our market right now. So I think definitely internationally, the different biggest standards are now trying to move towards more comparability. And I think as we get more standardization and we get better data and we are asking better questions, then there will be less room for ESG washing.
Last question before we round up the episode. It's about the legacy of ESG. At the moment, you pick up any paper, you switch on a TV, you read any business to business press. Those three letters would come up, right? ESG is definitely a hot topic right now. How is this going to be translated into a lasting practice? Is it real? I mean, is it just a fad, do you think? Or is this something more? Is this going to be something more substantive going forward?
Well, you mentioned the three letters of ESG, and actually, most recently, a special report by economists was challenging the three letters of ESG, saying that we should actually just focus on emission, as there are some fundamental problems in ESG that are distracting us from the real challenges that we should solve. So I would say if we just look at the number of regulations around the world that are growing, that ESG related, is certainly not just a fad from that perspective. Regulatory pressure is just going to continue to grow. But again, I would like to bring us back to the purpose of doing ESG. If as a company you believe in how ESG helps create long-term value by aligning the interests of profit, people, and planet, or as a financial institution, as a bank, you believe in giving your capital to companies that create such long-term value, then ESG would be much more than just risk or compliance. It would become how you seek business opportunities and growth, right? And if it's that, then it would also just be more than reporting, and company will integrate it in their governance and policies and processes, and making long-term change as like the question that you're asking, right? But again, we need to be realistic and pragmatic, and noting that there are definitely still many challenges and confusion in the field. But I believe that's the focus of our next episode.
Excellent. I mean, I guess it's quite easy to get behind, right? I mean, most people I know care about the environment. Most people I know care about sustainability, and most people I know understand that you need governance when you're doing business or playing any sort of game, right? So I guess it's pretty easy to get behind, and assuming you can make money from it, it is what we would say is a no-brainer, right?
Yeah, but definitely there are challenges, right? Like to do deep ESG, it requires a lot of also understanding of the E and the S, the issues that are material to your business. You may need extra costs, put systems in place. So it is, and if the figure is actually 90% of the world's business is SME.
Yeah,
SMEs.
Hong Kong is 98%.
Yeah, so globally it's 90% of business and more than 50% of employment worldwide. So if we're looking at the SMEs, how we can help them, as Penny earlier mentioned, to do deeper ESG. The commitment is a first step, but definitely there are challenges.
Yeah. And, you mentioned about newspaper. You can't overlook the fact that if you look at the classified page, everyone's looking to hire ESG expert, and there are actually none because it's so new, right? So it's also to finding the right people to help you build that practice.
Thank you very much. It's time to end this episode. So thank you, Penny. Thank you, Tze-wei, for taking us through this. And I look forward to speaking to you on our next episode.
Thank you.
Thank you.
Thank you, listeners, for listening. And I look forward to talking to you on our next episode.